Hey there, financial adventurers. Welcome back to the channel where we demystify the complex world of hard-to-borrow stocks and short-squeeze potential. Today, we're diving deep into a specific name that's popping up on our radar due to some incredibly high borrowing fees, Edible Garden AG Incorporated, or EDBL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on EDBL. Edible Garden AG Incorporated is a fascinating company operating in the consumer defensive sector, specifically under farm products. They specialize in controlled environment agriculture, offering a variety of packaged produce from cilantro and rosemary to living buttercrunch lettuce and basil. Show company logo/products. Currently, this micro-cap company has a market capitalization of just $1.06 million. Despite a slight uptick today of plus 2.4%, EDBL has seen significant downside recently, dropping over 20% in the last 5 days and a staggering 73.3% over the last 30 days. Volume today was relatively light at 325,700 shares, which is only about 0.2 times its 30-day average. What is cost to borrow and why it matters? Before we get further into EDBL, let's quickly review the basics. When you want to short sell a stock, you essentially borrow shares, sell them, and hope to buy them back later at a lower price to return to the lender, profiting from the difference. But borrowing those shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. The higher the CTB, the more expensive it is to hold a short position, and often the harder those shares are to find. A CTB over 100% means it costs more than the stock's value per year just to maintain the short. Why this stock is hard to borrow right now. Now this is where EDBL gets really interesting. Our screeners flagged Edible Garden with an absolutely massive annualized cost to borrow fee of 797.5%. Think about that for a second. Nearly 800% per year. Highlight CTB number. This tells us that short sellers who want to bet against EDBL are paying a premium unlike almost anything else out there. Why? A primary reason is the incredibly tight supply of shares. EDBL has an estimated float of only 0.1 million shares. That's a tiny number. With such a small float, even a moderate amount of short interest can quickly make shares extremely hard to locate for borrowing. We currently don't have data on the exact number of shares available to borrow, but with a CTB this high, it's safe to assume they are scarce. Our internal composite squeeze score for EDBL currently sits at 47.0, indicating notable factors are in play. Squeeze mechanics explained. So, what does a high CTB and tiny float potentially mean for a short squeeze? Imagine a situation where short sellers are paying nearly 800% to stay short on EDBL. If something causes the stock price to start climbing, perhaps a positive news catalyst, or even just increased buying pressure, these short sellers face a dilemma. The higher the price goes, the more their short positions are losing money, and simultaneously the borrowing fees continue to eat into their capital. At a certain point, the pressure can become too intense. They might be forced to cover their shorts, which means buying back shares in the open market to return to the lender. In a stock like EDBL with a minuscule float, this forced buying can create a powerful feedback loop. Buying drives the price up, which forces more shorts to cover, which drives the price even higher, potentially creating what we call a short squeeze. Dilution risk check. One critical factor we always assess when looking at short squeeze candidates is dilution risk. Dilution happens when a company issues new shares, increasing the total share count and often pushing the stock price down. This can completely negate a short squeeze thesis, even with high borrowing fees. For EDBL, we checked for recent dilutive SEC filings like SMINUS 1s, SMINUS 3s, or 424BS. And here's some good news, we found no recent dilutive SEC filings in the last 90 days. This means the company hasn't recently flooded the market with new shares, which is a positive sign for potential squeeze dynamics, as there isn't an immediate new supply of shares to absorb buying pressure. Recent reverse split watch. Now, there's another very important piece of the puzzle for EDBL, our recent reverse stock split. On July 13, just 17 days ago, Edible Garden executed a 1:45 reverse stock split. Chart chart with split data. Reverse split effectively reduces the total number of outstanding shares, and in EDBL's case, it would have contributed to the incredibly small float we see today. It also resets the share price higher, often to bring a stock back into compliance with exchange listing requirements. Historically, with many microcap stocks that undergo a reverse split, we've observed the tendency for renewed volatility or even a price pop within about a month after the event. This is a pattern seen in some small cap names, not a guarantee, but it's certainly something to keep in mind when looking at EDBL's current setup, especially combined with the sky-high cost to borrow. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should we watch for with EDBL Garden AG Incorporated? The incredible 797.5% cost to borrow and the tiny 0.1 million share float are clearly the standout features here. These are the ingredients for potential volatility. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will continue to fall, and they are willing to pay those exorbitant fees to maintain their bearish bets. EDBL's recent performance, with a 73.3% drop in 30 days and currently low relative volume, suggests that shorts may feel validated. Show EDBL price chart. Keep an eye on any sudden increases in volume, especially on green days, and any news catalysts that could shift sentiment. The post-reverse split period within the next couple of weeks could also be a time of increased activity. EDBL Garden AG Incorporated, EDBL, certainly presents an interesting profile for those following hard-to-borrow stocks. With a near 800% CTB and a minuscule float, it's definitely one to keep on your watch list for educational purposes. But always remember the risks involved with highly volatile microcap stocks and that high short interest can cut both ways. If you found this deep dive into EDBL insightful, make sure to like this video, subscribe to the channel for more unique stock analysis, and let us know in the comments what other hard-to-borrow stocks you'd like us to cover next. Until then, stay safe out there and happy researching.